Good morning, folks. It's been a very sad week for India with the massacre of so many innocent tourists in Kashmir by terrorists. It is unimaginably sad that these families that went there to have a good time came back losing their dear ones. There will be repercussions. The Indian government is not going to be sitting quiet on this. We still don't know what are the ramifications and what are the scale of repercussions that could be there. But one thing we can be sure that repercussions will be there, and this is reflective of the uncertain times. Things can change so quickly and changing our outlook also. So let's see what the papers have to say for the last few days. Okay, there is an article by Rajni Sinha, who's a writer. The writer is the chief economist at CareEdge Ratings, and she sort of has summarized the economic impact of all that has been happening as far as the tariffs are concerned on India. She does make a point that while the tariffs will have an impact of 0.2 to 0.3% degrowth in GDP, this is not new. This trend was already evident over the last 1 year, where GDP started falling from an average of 8.4% in the previous years to about 6.5%. And she attributes much of this to elusive consumption and lower government spending, which also are actually connected. Lower government spending because of probably the election cycle. Okay, but the Mahakumbh Mela and the renewed government spending could possibly bring back growth to track. Okay, and we are going to examine a very much more interesting article later on during this podcast as to what should the government be doing to bring back growth outside beyond the 6%. Okay, so lower interest rates would be supportive for growth and countered by global uncertainties. Okay, with goods exports to the US accounting for only 2% of India's GDP and a relatively low reciprocal tariff of 26%, we estimate the direct impact of the higher tariff to be limited to around 0.2 to 0.3% of GDP only, which is very, very less compared to most other nations. Okay, but the indirect impact of the trade war could be more severe. As global growth slows, there will be repercussions on India's overall exports, including services exports. Over the last 6 years, India's goods exports have grown at a compounded annual growth rate of 6%, while services exports led by IT and IT-enabled services and global capability centers have grown by 12%, double of the goods growth rate. India's services exports could also feel the pinch if global growth falters severely. The IT and IT-enabled sectors are major employment generators. Hence, any weakness in this segment could also dent the job market and consumer sentiment. So these could be the indirect impacts of a slowing economic growth. And the IMF did come out with a report this week as to how much tariffs would impact different nations. Obviously, all nations have been impacted one way or the other, lesser or more, not one way or the other. All of them are going to face a degrowth. And the IMF says that from 3.5% earlier projection, it could be about a 2.8% global growth only for the current year. The turmoil could also have a lot of impact on flows into India, whether FII flows or FDI flows. Both have been falling over the last 1 year as compared to the previous year. So that is a matter of concern. And the scale is not less either, small either. Net FDI investment inflows into the country slowed to $1.4 billion during the first 10 months, down from $11.5 billion in the same period of FY24. That is just a fraction of what we received the previous year. And FII flows were also muted at only 2.7 billion in FY25 compared to 41 billion in FY24. So capital inflows could remain weak in FY26 also. Okay, and private investment may also remain on a slow growth trajectory given the uncertain economic environment. So that's why overall GDP growth for India could just be around 6.2% this year unless things change or there are some major reforms that the government takes up. in order to tap the global opportunity that could be opening up in supply chains and the tariffs impacting some of the Asian countries. But however, she says that we do not expect a sharp and sustained weakening of the rupee in FY26 as the US growth outlook worsens with repercussions for the US dollar. So she says that the rupee could be more or less in the same range as where we are, with no further weakening more. And the RBI likely to be cutting rates more to support growth. The Mint also says the IMF says the US will avoid a recession. How? Well, what has been pushing the US into recession or likely to push the US into recession is the chaos caused by tariffs. So it can only avoid a recession if there is some stepping back from the trade war that the US has initiated. So that seems to be the only thing that the article says in this entire page. Okay. It says, however, the IMF for now does not expect the US to enter a recession as its economy entered 2025 with firm momentum. But it has warned of significant downside risks and negative shocks which have forced it to raise the probability of a US recession this year to 40% from 25% earlier. So it's like IMF is just walking on the fence saying either this or that, but no clear view on what. And it's just that the gut feel says there is going to be a slowdown everywhere, and unless a trade war worsens, the US will not be avoiding a recession. Okay. So oil prices have fallen down, as we all know, and the headline here says oil's fall to bring down fertilizer subsidy burden and ease fiscal strain. So cheaper oil could help India save 45 to 50,000 crores in import bills, assuming consumption remains at FY25 levels and rupee remains stable. Okay, and average crude prices are remaining at about $60 to $65 a barrel. Subsidy savings, they say, could free up fiscal space for increased public investment in infrastructure and welfare. At the same time, falling input costs improves profit margins in energy-intensive sectors, strengthening the overall investment climate. However, I would like to take this with a pinch of salt and look at the flip side also. Yes, we would be saving money from oil import bills coming down, but just remember that the budget also factors in a large revenue of almost 2 lakh crores coming in from capital gains taxes. And if the stock market is not going to be so buoyant, we can see a significant fall in collections in capital gains taxes. So you may save some money here, but you're not going to earn as much revenue as you thought you would. So does the government have that fiscal space to spend more? I'm not too sure, only time will tell. So I would take this with a pinch of salt in this sense. Very, very inspiring headline here. It says, Amul's revenue touches 90,000 crore in FY25. Amul has grown into a huge cooperative. 90,000 crores is a big deal. Okay. And what I'm liking here is the last paragraph of this article. Okay. Amul has entered the US market with its fresh milk and partnered with Michigan Milk Producers Association for this. Under the partnership, MMPA will collect and process the milk, and the Gujarat Cooperative will handle the marketing and branding for Amul in the country. The cooperative, which started in FY74, now exports its products to more than 50 countries. So on the one hand, you have the Trump government wanting India to open up its dairy sector to buy from US. On the other hand, you have Amul going to the US. Of course, it is not taking milk from India, but you have the brand going to the US and doing better for their own dairy industry. This is wonderful news if you ask me. Thursday newspaper says, no intention of firing Fed Powell. Trump says this. So the flip-flop over the last few days on almost every issue by Trump has been confusing the heck out of all markets, whether it is stock markets, bond markets, gold or crude or any other market. And markets took a very, very dim view of the fact that the US president may want to fire an independent body's chair, that is the Fed's chair Powell, and they all fell in panic. And a day or two later, Trump comes back and says, no, actually, he has no intention of firing Powell, and that takes the markets back up. So we really don't know what's going to be happening. I've said this before, I'm saying it again. Every headline, every day, every moment could change the scope of markets. Okay, and one of the worries was that China would dump its excess production on India, and finished steel is a large portion of the imports that we have from China. And if they choose to dump more, it would impact Indian steel producers. Thankfully, the government of India, it says here, has imposed a safeguarding duty. So the note here says, safeguard duty imposed on steel imports to protect domestic producers, effective for 200 days starting 21st April. This decision comes amid rising concerns of over-dumping of cheap steel, particularly from China, following the US tariffs. India's steel imports surged 15% to 9.5 million tons in FY25, while exports fell 35% to a decade low of 5 million tons of steel. A safeguard duty is seen as necessary to protect local manufacturing, investments, and jobs. So the safeguard duty is 12% that the government has imposed. I'm happy. I hope they take quick action on all other industry sectors also to protect our domestic industry ahead of time. Again, another interesting headline. It says, foreign ETF lovers catch new fancy in China and Brazil markets. Okay, so it says here that retail investors romancing the US through ETFs are discovering new vistas in emerging markets this year. Many Indians who invest under the RBI's LRS scheme appear to have shifted preference to China and Brazil since the start of the year. Data from various broking platforms have indicated. Okay. The change comes amid a steep fall in US equities after President Donald Trump unleashed a tariff war. Okay. So the paper that spoke to 6 brokers who offer direct access to global markets found that investments into China and Brazil grew relatively more than the US in the current year, albeit on a low base. But it does show that Indians have been investing almost 10 times more than what they did in China and Brazil this year. If you're looking at the US market cap relative to the rest of the world, it used to be at around 50%, but over the last 2 to 3 years post-COVID, it rose to almost 70% and is slowly coming back to about 62%, and it could be tending to the earlier average of around 50-51%. And signs of it are there as investors move to other markets from a US focused investment strategy to Europe, emerging markets, etc., as this article also seems to be saying. So yes, diversification is the need of the hour. It has always been the need, whichever time period you have taken. Okay. So here we have an article by V.S. Krishnan. Okay, he is a former member of Central Board of Indirect Taxes and Customs. Okay, and his headline is "Breaking Out of the 6% Growth Trap." Interesting to note that for many decades, 4% was the growth trap, and the rest of the world would make fun of India and says 4% is the Hindu rate of growth. Now we are saying that 4 has now become 6, and let's break out of not a 4% growth trap, but let's break out of a 6% growth trap. And Christian picks out 4-5 data points to show where we should be going, where we have improved, and where we should be growing. So he's taken the last 25 years growth to pick out these points, where we were in 2000 and where we are in 2023, 24, and where we should be going. Okay, so he says clearly the magnitude of growth that we see is very important, and how do we reach where we want to be and break out of the 6% trap. In the past 25 years, India's growth rate has been stuck around 6%, except for the period 2006 to 10, when India briefly reached 8%, aided by the reforms in the earlier Vajpayee period and the favorable global trade winds. The reason for this was that in this period, investment reached 39 to 42% of GDP, and private investment was around 18%. The investment levels are now at 33%, not the peak of 42, but at 33. And private investment is down to only 9.8% as compared to 18% in that great period. The other worrying area is a declining employment intensity of investment, which requires a greater focus on investment in labor-intensive manufacturing. In the table here, it says investment to GDP ratio was 26% in 2000 and now at 33.5%. And he says unless we have a target of moving it to at least 35 to 37%, it would not help us improve our growth rate beyond the 6%. Okay. Then the employment elasticity of investment, that is how what he maintains is the additional investment is not generating as much employment as it should be. The elasticity of investment as related to employment earlier was 0.44, now it is only 0.21, okay? Which means that if we are investing, we should be investing more in labor intensive industries than others if we want to generate employment and grow consumption and growth rate. Export to GDP ratio was 13.2%, has moved up to 19.5% in 2024, and the tax to GDP ratio, which was only 14%, is now 18.5%. The tax to GDP ratio is very important because if that ratio goes up, that means the government has more money to spend on social schemes. Of course, the other one that gives it the fiscal space is the interest payment to total receipts. So it was 39% earlier, come down to 25%. It still means that a quarter of our spending is going towards interest payment. Needs to be coming down. This plus revenue, if it goes up, we have more fiscal space. So this is what we as Christian has to say, points to really take note. During the week, we had all markets going wildly up and down, whether it was a Nasdaq, the S&P 500 or the Indian Nifty. All of them had a crazy, initially we thought that things were going well and then things did not go as well. The primary issues that confused the markets in the last few days were Trump saying that there would be higher tariffs on China and especially on semiconductors, and Nvidia saying that they would have a charge of $5.5 billion for the exports that they would have to China, which impacted Nvidia stock and all the tech stocks together. So markets went up, down, etc. And the Nasdaq anyway ended with 5.4% gain in the since last Friday. The Nifty went up since the last 1 week by 2%. The S&P 500 by 3.8%. Gold went up by 1.2%. Initially, the parabolic rise continues, led by panic that the US government, or rather Trump, would be unorthodox in trying to fire the Fed's chair Powell. And that led to a lot of panic, and it weakened the DXY also. The DXY did go up by about 0.4% in the period. Oil fell 1.4%. The rupee depreciated by only 0.2%. So initially when the markets thought that the US would avoid a recession or a slowdown because Trump said, hey, I don't think I want to be imposing such high tariffs on China. It is not going to be sustainable. It sort of led everybody to believe that he would back down. And tech stocks moved up in India. But with Trump coming back and saying that unless China reciprocates and unless we come to the table, blah, 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 I'm not going to be reducing tariffs. So we're back to square one. And eventually the Nifty IT index went up only by 0.4% over the last 7 days. So the Trump flip-flops have been roiling, and I think they will continue to roil and confuse markets across the world. So have a good weekend, and let's hope we have a better week ahead.